Lots of proactive tax planning is required to manage around how your Social Security is taxed at the federal level. But which states tax Social Security as well, and what planning opportunities exist for you to avoid that? Got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. How Social Security is taxed is one of the more confusing things about Social Security, by the way, and one of the more important things that you need to be planning for, doing proactive tax planning for throughout your career and certainly in retirement, because a lot of it is going to be based on choice. How you structure your retirement savings and whether you do proactive tax planning, that's going to influence that, as you retire and draw dollars out of your retirement nest egg, what sort of taxation there will be, and that will influence what sort of tax you have to pay on your Social Security. At the federal level, if you're a married filing jointly, there's a formula that's done every single year on every single tax return, and that is add up all of your non-Social Security income, so IRA withdrawals, pensions, dividends, capital gains, interest income, all that sort of stuff. Add all that up, plus half of your Social Security. And when that number is greater than $32,000, some of your Social Security starts landing on the taxable side of your tax return. And the higher that number is, the more of your Social Security starts becoming taxable, the more of it starts becoming taxable. If that formula is over $44,000, so not a big runway there, then up to the maximum amount of your Social Security is included on your tax return at a federal level, and that's 85%. Not the tax is 85%, but 85% of your Social Security ends up being taxable to you on your federal tax return. So think if your Social Security is 10 grand and that formula is greater than 44,000, the maximum amount of your Social Security that can be taxable at the federal level is $8,500. So that's the threshold, that formula, and the threshold at a federal level. By the way, if you're a single filer, then that same formula is done, but that income threshold that you need to exceed or ideally stay below is $25,000. So what can you do to save up for retirement and structure your nest egg so that as you draw dollars out of your investments, you can stay favorable. You can stay below these income levels for Social Security. That's a big proactive tax planning question that you need to be working with your CFP on. But oftentimes, as we talk about that, we ignore the state, right? There's a cluster of states that don't have any state income tax. States like South Dakota, states like Tennessee, Florida, and Texas. Then there's a large swath, the majority of states do not tax Social Security. So a certain cluster of states don't have any state tax. A large majority don't tax Social Security. But then there's a handful, there's a few, 10 or so, that actually could tax your Social Security depending on your situation. And you want to be aware of this so that you can again plan ahead throughout your career, but also do proactive tax planning during retirement. So these states, how do they tax Social Security? Well, it's based on a few different factors. Colorado, just a couple, could be based on age. Well, if you're drawing Social Security and you're below a certain age, then we may tax it. If you're above a certain age, full retirement age or age 65 or whatnot, then we won't tax it. So some of the taxation could be based on age. A lot of it is going to be based on adjusted gross income, and there's going to be phase out. So very similar to how it is at the federal level, you need to be aware of what your adjusted gross income is, what your other income sources are, and that's going to influence whether you pay tax on your Social Security. And then finally, some states may just look and say, well, are you paying tax on your Social Security at the federal level? Then our state might tax it as well. So those are the different ways your Social Security could be taxed by these states. So which states do tax Social Security? Well, I've got a list here. This is from about a year ago. It lists 12 different states. 2 of them, starting in 2024, are no longer taxing Social Security. So looks like about 10 of them, but I'm not fully up to speed on whether certain states have recently passed some legislation to say we're no longer going to tax it or we're going to start taxing it. But here's the list. Take a look here. Colorado is one of those states where it depends on your age as well as some of your income, whether they're going to tax Social Security or not. Connecticut If your adjusted gross income is above certain levels, then they're gonna tax your Social Security. You're gonna need to be aware of that. So here again, this is where if you are able to draw dollars out of maybe a Roth IRA, or you have some tax-free retirement income, maybe you're supplementing your Social Security from withdrawals from a savings account, something like that, and you're able to keep your adjusted gross income low, it's gonna avoid or you're gonna save tax on your Social Security at the state level. Kansas is similar. If your adjusted gross income exceeds $75,000, your benefits are going to be taxed. Minnesota, similar as well, that if your income's above a certain level, your Social Security could be taxed. Montana as well, it's going to be based on your federal adjusted gross income. New Mexico, Rhode Island, Utah, Vermont, West Virginia, I mean, the bulk of these, it's going to be based on your adjusted gross income. So whether your Social Security is taxed at these states, it's really going to depend on your proactive tax planning and what your tax picture looks like, your adjusted gross income, and at the federal level. That's going to determine whether you're going to have to pay Social Security, whether you're going to have to pay state tax on your Social Security. So what's the takeaway? Well, first you've got to build this into your planning. Whether you're living in a state that currently taxes Social Security, or you are aware that you may not retire in the state that you're currently living, that you may move. You want to be aware of this list. You want to build it into your planning. I've talked about this before. So many people, as they're building out their retirement forecasts and planning for retirement, they ignore the impact of taxes on their retirement plan. This is significant, guys. We would categorize it as an expense, as a cost. It's a drain on your resources, taxes, and therefore you need to build this into your planning. And our systems, our tools that we use, how we plan for retirement, we not only do a forecast and plan for taxes at the federal level and have that factored in to the retirement plan, but also at the state level. So state taxes, local taxes, even taxation on Social Security. So you've got to build this into your planning. That's number one. And number two, of course, you've got to be aware of what things can you do proactively to improve these formulas, to lessen the amount of tax that you're going to pay in retirement, and certainly on your Social Security at a federal level and at the state level. So often people get to retirement and they say, okay, well now what planning opportunities exist? Not realizing that how they saved up throughout their career is going to have great influence on what the taxes they're going to pay in retirement. Think of it this way. If you're living in one of these states, advantage Roth, right? If for everyone else and across the country, if you're doing the calculus to say, well, should I fund pre-tax or should I fund Roth? Should I do Roth conversions? If that decision also influences whether your state is going to tax your Social Security, I would say that's another reason to consider doing a Roth contribution, Roth 401k, Roth IRA, or even a Roth conversion. And then I would even explore other more creative ways of saving up dollars and having them be tax sheltered, maybe shoeboxing your HSA, something like that. So proactive tax planning, working with your certified financial planner, aware of these rules, understanding whether they could impact you or not, and then what you can do about it. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.